are you seeing things in a way similar to how hedge funds are seeing them? Are you seeing maybe it's time to take some money off the table in the U.S. and look at the international markets?
We are still bullish on the USA. We're Team USA. We've been that way for several years. I mean, the outperformance has been pretty wide. So on a short-term basis, you can certainly get some of that back and consolidate. But as we look over the next year to 18 months, if you have a global economy that's slowing down, historically, the U.S. tends to outperform. But again, on a short-term basis, maybe a bit extended, but we would not shift our position for anyone that has like a year or so outlook.
So back in May, you were one of the first people I heard talk about the equal-weighted S&P 500 index. I want to give you a little bit of credit. So if you look from June, that's when the market first started to broaden out in a lot of people's opinions. You see outperformance by the S&P equal-weighted index and also by the small caps, the Russell 2000. Is that where you would put money to work today and even for the rest of the year, as you believe the market is broadening?
I think at least for the next several months, I think the equal-weighted index is likely to continue to outperform as those big cap tech stocks take a breather. We still like big cap tech longer term, but we also just came out of the best first half for the NASDAQ since 1983. So some digestion, I think, makes a sense there. And then if you look at the equal-weighted S&P, it's trading at a more reasonable PE around 15. And in early June, right around the time we decided to increase our exposure there, it had the greatest underperformance on a 3-month basis to the market cap S&P that we've seen in the last 30 years. So we think that rubber band got stretched too far, and we think we're going to go ahead and see some more mean reversion or some more upside for that equal-weighted index relative to the S&P.
Well, Keith, with that in mind, what is your WEX word of the day?
Okay, Frank, the word of the day today is consolidation for the headline market. And the reason why we think that, Frank, is, again, we just talked about the NASDAQ had a big first half, the S&P had a big first half. And right now we're heading into that big CPI print tomorrow, and we're heading into earnings kicking off next week, which we think we'll have to, where we think the expectations are much higher. So listen, I think it's more of a consolidation, kind of a chop back and forth, backing and filling, just to, again, digest these big gains that we've seen year to date so far.
You had a pretty big windup there, Keith. I was expecting something totally contrary. A lot of people are seeing some consolidation coming up. So with that in mind, today, you mentioned the equal-weighted S&P. Where else would you put money to work today, whether it's a sector or an individual name?
Yeah, I think overall we still are bullish on the industrial sector. It did have a big month last month overall, but you have a lot of positive tailwinds as you think about infrastructure spending, onshoring, defense spending as a whole. So within the sector side, that's our favorite area. Over the next few months, if we see some of these technology companies come in and just maybe correct in time, we think that will be an opportunity, but we think it's more of a resting period for them.
Is your theory on the industrials, is that based off of reshoring? And you're saying also the infrastructure bill that passed, we're seeing a lot of that funding come through in recent weeks?
Well, I think it's going to be a multi-year story. So it's not weeks, but I think there's going to be this trickle that continues to provide, revenue opportunities for a lot of these companies in a time where we think the overall economy is still where the overall economy is likely to slow. So normally if the economy slows, you don't want to be industrials, but there's a lot of these tailwinds that will likely continue, not for just the next couple of months, but the next couple of years.